Good afternoon, everyone. This is Brad Matheny. Today's the 20th of September, and I was taking a look around at some of the market data related to the Fed. And as I mentioned to you a couple days ago in my What to Expect After the Rate Cut video, you know, I see the Fed move the recent rate cut a little bit differently than a lot of people. I read articles and CNBC, people are coming out saying, oh, Powell knows something and he's not telling us, and this and that and the other. I think, to be honest with you, and let me add the Fed funds rate here. And of course, it's going to end up somewhere down here at the bottom, I guess. Where did I add it? Silver, I don't want. Fed funds rate, so it's here. Okay, let me try this again. Add symbol, Fed funds rate, new pane. So here's the data, and this is daily. So we don't really have an updated, but again, it doesn't show it here the way I want. But I think the Fed is lowering rates to effectively provide breathing room for the global economy. So understand this, that the Fed was really not defending anything related to a crisis, in my opinion, other than potentially some of this type of a crisis move here. Remember when the Bank of Japan made their move, raising rates, trying to defend the Japanese yen? There was a scenario going on here, and I called it with a video saying a shot across the bow. And that was that, foreign central banks are now starting, or worse, continuing to feel the pressure of the Fed keeping rates up at 5.5%, while they were struggling with their economy and what to do. This is again the 900-pound gorilla. The U.S. economy is strong, consumers are strong, housing is strong, home building is pretty good, retail sales are pretty good. We're moving into the fourth quarter. We haven't had any real large collapses, any real crisis. And I think that's simply because the Fed has put quite a bit of effort into stabilizing the monetary system in the US. There's a lot of money out there. There was a lot of stimulus out there. They've contained a couple of bank failures over the last 3 or 4 years. And it really came down to the point that the Fed raised rates to try to lower inflation. Now inflation is moving downward. The market is contracting a bit. I think they were over adjusted in the rates compared to the world market, and this created a bunch of pressure on the world market. And so now the Fed, by lowering rates, has alleviated some of that pressure in the world market. And the way I would explain it to you here on this chart here is, let's go way back to 2022, when the Fed started raising rates. So here we go. 2022, Fed started raising rates throughout all of this time frame. And what we saw here was the Japanese yen. And again, I consider the three largest economies on the planet to be, excluding China, because China is going through what I think is a very similar process to the dot-com bubble, a big speculative, I don't want to call it meltdown, but essentially that's what it is. It's Japan of the 80s happening in China right now. But what happened is we had the rates increase, the Japanese yen, the market, the Nikkei contracted, then rallied into this. Remember, this was, post 2022. We had the elections in 2020. We rolled into this mode here through basically safety, rolling into the Japanese market. The Japanese market, the Great Britain, and the US are the three largest economies and markets on the planet. They have been for years. Safety is going to be found by money moving into those three stock markets and currencies, simply because they're the biggest, most stable, most dynamic economies on the planet, generally. Okay. Now, this weakened trend here, you can see the rally phase that took place. And I believe the extended pressure here of the Fed not removing, go to weekly, not lowering rates created a fairly strong, I don't want to call it crisis, but a fairly strong pressure mode in this area. I think this was the area where the Fed, where the Japanese central bank pretty much said, enough. We can't take this right now. Our yen is collapsing compared to the dollar. We are seeing foreign capital rally into our stock market, but it doesn't do us a lot of good when the yen is collapsing against the dollar. And the yen collapsing against the dollar puts pressure on them to be able to pay more to borrow, pay more to pay off debt. They'll understand that if they're borrowing from foreign markets or letting people come in and borrow the yen, if they're converting hypothetically Russian rubles hypothetically into yen, great. Okay, maybe there's a parity there between the currencies. But if the yen starts to collapse and the ruble holds value, then Japan is essentially paying more and more of their own currency to settle their debt. So, and then the way that works is a very simple process. If this is the X currency and this is Y currency, and one party A is borrowing against funds in B, great, no problem. If they're at parity, there's really no problem here. But if this one decreases to here and this one increases up a little bit, now in order for A is loaning money to B, and it's at a pair value, now B has to repay A back over here. Their currency value is lower compared to this currency value being a little higher. They got to make up this difference by coughing up more of their own currency to pay back their debt. And that's really what's happening with the Fed. The Fed kept interest rates high. Okay. It put a lot of pressure on currencies. And when these currencies shift, as I mentioned over here, what you're looking at is a dynamic that can greatly affect central banks and borrowers, to the extent that, hey, everything is okay as long as we maintain parity and everything looks pretty good. So, if you come in here and you go USD to JPY, dollar to Japanese yen, look at how this has rolled. So here's again 2022, dollar to Japanese yen. Remember, going up means the dollar's getting stronger, the yen's getting weaker. Okay, this is where that real parity trade came into play. And look at how this played out. We haven't had this kind of a rally up in this extent. Here's a 57% rally. Here's a up to this area, 53% rally. We haven't seen this move. And again, this 100 level here is roughly parity. So 101, 100, that's parity. Yen is equal to the dollar. Down here, the dollar is weaker than the yen. So this means that you get $79 if you were to try to sell a yen to get the dollars. You would sell 100 yen to get $79. In this case, you would have to sell 122 yen to get $100. In this case, you'd have to sell 156 yen to get $100. That's how this works. So this becomes upper pressure. This means the yen is weakened. This means the yen is extremely weak. And that's why the Bank of Japan made the move. They had to up here at 160. Now you're talking about, if it would have kept up, you're talking about a 2-to-1 ratio, meaning that you have to sell 200 yen to try to get 100 US dollars. When historically, and I've been over to Japan many, many times, but historically, we operate kind of in this normal range here, kind of in this area. That's the mean of this. In fact, I can kind of show you a mean here by essentially adding a SMA, moving average, simple, and I will come in here and set it up to a 200 period. Let's call it 250, which is yearly. In this case, it's weekly, so that's going to be about a 5.5 year average. And there you go. So come in here, set the style, make it a little thicker, and make it purple. So you can see here the mean in this area is fairly narrow. In fact, you could probably come in here and do the same thing with a regression channel, hypothetically from here to here. There's your regression channel. Now that's I think a 1% regression. 2. So let's make it 1 and 1. And there you go. That's the mean level of the yen over the last couple of years. It's really in this, 90 to 110 area. And this big breakout put a lot of pressure on the market. So what we're looking at right now, and again, this happens in all types of currencies. So look at the US dollar to Canadian dollar. Okay. Here we go. Here's the move. So here we go, 2022. Remember, Fed started raising rates in 2022. So this means as the US dollar grows in value, the Canadian dollar weakens in value. And remember, the Canadian dollar hasn't been at parity with the US since back here. So there's parity. That's 2013. So we have seen the Canadian dollar really weaken in 2016 and even worse in 2020. Okay. And now we're flatlining over here, kind of in a kind of a flagging formation. You can see here, kind of just flatlining across here. And really, we have a flagging pattern setting up here. Probably going to get, if I were to guess, probably going to get because A, B, C, D, okay, rolling A up. This to me looks like it's about ready to break and go higher. So we shall see. But again, this is the real parity issue, the real currency issue that is driving the Fed move. So let's come back here to the Japanese yen and let's take a look at what's actually going on here. What this move in the Fed is about is not necessarily related to some crisis event in the US or some pending banking or other issue. Yes, it's going to roil the markets a little bit. It's going to cause some disruption. But I believe ultimately the strength of the economy, again, and I'm going to draw, and you guys know I always draw. So imagine we have over here the US, the biggest economy on the planet, Japanese yen, and let's call it Great Britain. They're about the same roughly in total GDP. In fact, I think probably Great Britain produces a little more. These are the biggest economies on the planet, and these currencies have been holding up fairly well. Now, the dollar over here, USD, has been dominant. It's been like the 900-pound gorilla. Okay, it's been a very dominant mechanism over the last roughly 2 years, 24 to 36 months. But the pressure that has been put on the rest of the globe, let's say the rest of the globe is over here, the pressure that's been put on the currencies through these primary uh, currencies holding up in value compared to the rest of the globe, what's happening is you're getting money is flowing into these economies saying, hey, why should I hold on to my, you know, I don't know, Turkish or whatever stocks? Pick a foreign country. Why should I hold on to them when I'm going to lose potentially 20 or 30%? Trying to draw a three, it doesn't work very well. Why am I going to hold on to them when I'm going to lose 20 or 30% in my capital when I could just move it over to this, or this? So this is Japan, and this is Great Britain. So why am I going to lose money just holding on to it when I can move it over here? And that's exactly what's taking place because the Fed raised the interest rates, and these economies are going to perform better than the rest of the globe. Money is flowing in this area now at 5.5%. It's really targeting this. It really wants to go in here. It's like, hey, get me in US dollar. US dollar, everything. I love it because the biggest, best economy on the planet. But now the Fed lowering rates, they'll come over here. Fed lowers rates, it takes the pressure off. So all that money coming over here is now going to be hopefully over the next 12 to 24 months, hopefully weakening a little bit. So understand that it takes the pressure off and allows a little bit more, maybe 10, 15, 20% to stay in this local economy as the currency shift. Fed lowers rates, the dollar's going to shift a little bit because lowering rates means that there's less of a demand in this mechanism. It's going to pump up these a little bit over time because more money is going to settle into these, and these economies will be able to grow. And if they're able to create some sort of a balancing act, remember, we're now at US dollar reaching way above what we will call a parity level, right? There's our parity level. So what would happen now is that we would be looking at this demand cycle here to weaken, and we would be looking for these to move down into more parity, potentially getting into a more narrow, manageable range for the globe. And that's what I think the Fed did. They moved away from some global contagion risk, not necessarily as a favor, but yes, as a favor to global economies, taking the pressure off and allowing the world to try to transition into a more organic growth. And that's the point I wanted to make with these charts is now we are going to watch more than likely this chart, this weekly Japanese Nikkei index, is more than likely going to roll into some moderate, I don't want to say contraction phase, but remember, we need to get into, and it's really going to be more of this. We need to get this, the Japanese yen. Look at what's happening over here. This rebound, this is weekly off the Fed move. We need to get this to move back down into this 128, 130 area right in here to eliminate this pressure that is built up after the Fed started raising interest rates. Ideally, we need to really get down into this area. And that's going to take, in my opinion, 5 to 7 years. So understand that this is all going to unwind potentially, but over the next 5 to 7 years, which is why I keep telling people the next 5 to 7 years are going to be the biggest opportunity of your life. If you really understand what's going on, why the Fed's making the move, why the US dollar is the 900-pound gorilla, why the US economy is unbreakable at the moment, why the presidency is going to probably drive new policy and spending, why the debt, even though everybody considers the debt a crisis, I'm going to tell you right now, if GDP continues to perform, we're going to be moving much cleaner into a debt to GDP ratio. Let me see, U.S. debt. Do we have anything here? Economy, U.S. government debt. So I'll try that. Okay, perfect. And now let's go ahead and try U.S. GDP. Okay, U.S. GDP. Exit. So we turn around and we go U.S. GDP divide by U.S. debt. And there we go. So now we have seen U.S. debt to GDP ratio increase. Okay, you see here 2020, 2020, 22, and we don't, looks like we don't have a lot of data here. But at this point, we would want to see the debt to GDP ratio move downward. Debt to GDP ratio is going to move downward over the next 5 to 7 years as GDP grows and as the debt grows. It's okay. That's how it works. And you need to understand that we are going to get to this area very, very quickly. Now, I wish I had more data. I'll try to get more data for you, but this is what's going to happen. But it's going to happen over the course of many, many years. Okay. So I can get rid of this. And I can show you that it's going to be more like that into 2030, 2033, into this area where I think the next big crisis event happens. Okay, again, this is designed to give you guys a feel for the broader context of what's taking place. The Fed made the move to take the pressure on the global market so the global markets can have a little spark of activity, which would lead to an organic growth phase going into the end of the year and into 2025. That's why the Fed made the move. Talk to you guys later.